Hello again, everybody. Dr. Richard Smith here with the Foundation for the Study of Cycles and Cycles TV. So welcome back after a wild week. Wow. We participated in history, the biggest move down in silver in the history of the markets. Better than the Hunt brothers back in the 1980s. Woohoo! Yeah, gotta love it. All right, well, we're not going to be talking about that today, but still, we are talking about cycles, and I'm going to be looking at cycles in emerging markets today. We haven't really talked about emerging markets, so I thought it would be a good area to have a look at and see, learn how to do cycles analysis by studying emerging markets. So thanks for joining us today. Hope everybody is aware of our Cycles in the City conference in May and excited to be there. It's going to be an incredible event, and I hope you'll be joining us. Before we get to the emerging markets today, of course, everything is always in context, right? And last week, one of the reasons being given for a precipitous move in markets away from precious metals and back towards the dollar and out of the debasement trade, etc., was the nomination of Kevin Walsh to replace Jerome Powell as the chairman of the Federal Reserve. Amazing how these events make a lot of noise, and yet a lot remains to be seen. But we are going to talk a little bit about Kevin Walsh and the Fed today, because we do know that the Fed is a very important institution and in a very important predicament that we've been talking about here for months now. And certainly last week's developments have implications for how that predicament of the Fed plays out. So we'll talk about that just for a little bit here in the beginning. My colleague, of course, Lars von Tienen, did a great show on cycles in the equity markets yesterday. So definitely check that one out if you haven't seen it yet. I'm not going to repeat the analysis of the equity markets. I think Lars did an incredible job, as he always does, highlighting where those cycles are at. And, you know, it's definitely the cycles are not very bullish on the equity markets right now. Doesn't mean that the end is here, but they're not very bullish. So we'll follow up, look at the Fed, talk about Kevin Walsh a little bit, look at some of our flags that we're looking to see if they're turning yellow or red, and then we'll do some cycle analysis on emerging markets. All right, so with that, let's get going. I don't know if this sound is going to come through, so maybe Dan, you can let me know if it doesn't, but I just wanted to play. I think this is an important talk panel that Kevin Walsh was on at the Reagan Foundation. This was back, well, it was posted on January 30th, 2026. I don't think that's when the talk actually happened, but I could be wrong. It was during the 2025 Reagan National Economic Forum in Simi Valley, California. So it was didn't happen on January 30th, 2026. It happened sometime last year. And we'll just watch about a minute of this. And then hopefully you'll be able to hear it. If not, let me know, and then you can go back and watch it another time.
In several words, first, it's an honor to be here. I always wondered what the shining city on the hill looked like, and it's pretty cool to see it once from my own eyes. For French, this is a little old home week because he served at the time that the president was in office. For most of us who came into government, guys like Farrier and me and some of the crowd, you know, Reagan was our hero when we were kids. And I would say for many of us, we wouldn't be here. We wouldn't be in public policy without his example. I'll say one other thing that I promise I'll come back with a longer answer than no to Greg's question. This is our Reagan moment. It was 44 years ago at a time like this. President's in office, the media's giving him hell. He's shaking up the establishment. He inherits a mess. People don't like what he's doing. There's some gauzy history about how easy it was. French can speak to it better than I. It wasn't easy. And this is that moment. This is that hinge point in history that we see every couple of generations. Doesn't make it going to be easy. Doesn't mean that every decision's obvious, but it's super exciting. So that's my thank you to the Reagan folks.
All right, so this is that moment in history 44 years ago. That was 1981. And this is our Reagan moment. Look, I like a lot of what Kevin Walsh says. I agree with Kevin Walsh that the Fed has gotten itself in between a rock and a hard place. I'm less enthusiastic about the ability of Kevin Walsh to get the Fed out from between that rock and the hard place. So if we look at what I have been saying is the most important chart in finance now for 10 years or so. Let me just take the cycle off of this and go back to full screen here. So this is the 10-year yield on the US, this is the yield on the 10-year US Treasury. Okay, and 1981, Reagan was right here at the peak in yields on the 10-year Treasury. And ever since 1981, right, all the way down to 2020, the yield on the 10-year Treasury was steadily going down and down and down and down, which made financing and refinancing very easy and desirable. And that happened for 40 years. Kind of culminating in the bottom here when all the rich people refinanced their homes at 2% mortgage rates and have been holding on to them ever since. We borrowed a lot of money here at the bottom at very low rates. The people with money did, right? Even though they didn't need to borrow. This is a big reason why what I talked about in my cycles market update last week, was it, or the week before, why the wealth gap is as atrocious as it is today. So, you know, are we here is this our Reagan moment? Here we are over here in 2025 now, okay? Is this our Reagan moment? Remains to be seen, but from a cycles point of view, okay, let's go back and look at some cycles on the 10-year yield. Now there is this 273-month cycle. So what is that, about 15 years? 15 times 12 would be 150, sorry. Not able to do that math in my head right now. 273 divided by 12, that's probably 244 is 12 years and then another 30. So about 15 years, right? So 15 years of each of these cycles, roughly 2 generations. That's what he said, 44 years ago. And here we are kind of at the top of that cycle. And if we do put our cursor here at the latest monthly data, which was from December, I think, of 25, and we look at the numbers in the spectrum down the right side, they're almost all red or turning red. If I just do a select all here on the cycles, they pretty much all point down. Okay, and again, you see they're all red. And certainly all of the cycles that show up as ranked in the spectrum are red, and the stable cycles are all red as well. So let's just focus on, these couple of cycles here. We'll make that bigger again. And we do see that, from a cycles perspective, the 10-year yield looks like the cycles are, I mean, the cycles on the 10-year yield are suggesting down on the monthly data, long-term data on the cycles, which is what happened back here during Reagan's time. I'm not convinced that these cycles, the 10-year yield can go down when it's starting at, let's say 5%. Back here, it was starting at 15%. So where do we go? Back to zero? I don't know what the Fed's balance sheet was back here. There's not data for it in the same way, right? So this is the Fed's assets on its balance sheet, right? We remember that it shot up during the great financial crisis, and it's been going up ever since, right? The Fed bought the treasuries and the mortgage-backed securities. So this is what Kevin Walsh doesn't care for. I don't care for it either. And he would like to shrink this balance sheet, but how do you do it? Okay. So it's not the balance sheet. Shrink these, assets that are on the balance sheet. Now, this is the one that the Fed does have some control over. These are the reserve balances that the banks are holding at the Federal Reserve. So this is a liability for the Fed, but it's the banks having reserves at the Federal Reserve. Why do they have to have reserves there? Because that's how they settle their balance sheets on a nightly basis, and the reserves that they have at the Fed help them to offset the deposits and withdrawals from their banks. And we remember that recently the Fed said we're going to stop just selling off the assets, and we need to start buying treasuries again to so that the banks actually the reserves don't sink further. And but this is very difficult to do because, and I know we're getting into the weeds here a little bit, but this is the overnight reverse repurchase agreements, treasury securities sold by the Federal Reserve in the temporary open market committee, right? They're not selling. And the banks want to hold on to their reserves there. They don't want these reserves to keep going down. And the banks are able to dictate to the Fed now what the reserve levels need to be because of what happened since the global financial crisis. So the Fed isn't in control of its balance sheet anymore. And I don't know how Kevin Walsh fixes that with the debt being what it already is, and without, allowing for some real pain amongst the asset holders and the financial asset holders in our country and in the world. So we'll see. Remains to be seen. Again, just looking at that, this was 1981, the Reagan era. Yes, the cycles pointed down, right? And they point down again today. But how do we go down from, 5% versus going down from 16%? That's the challenge. So time will tell. In terms of the kind of red flags we've been looking for, or this is the standard overnight financing rate, SOFR minus IORB. It's ticking up a little bit, right? So that's telling us that that the treasuries as collateral is being priced a little higher now. We normally want that to be below zero, but nothing really dramatic yet. This is the MOVE index on the kind of the VIX of the bond market. We see ever since, the walk back of the Liberation Day that they've continued to go down. The volatilities continued to go down. So no big stress showing up there yet. And then this is the high yield option adjusted spreads. And they did tick up a little bit, since over the past couple of weeks, since January 22nd. So we don't, really want to. So this would indicate some stress in the high yield credit market. But again, I'd say these are not market changing moves that we've seen so far. So let me just back out of here for a minute. So to sum up, we got a new Fed chair nominee. He wants to reduce the Fed's balance sheet. He's saying this is our Reagan moment. And, the Federal Reserve needs to get out of the way and let private markets take over. But that's difficult to do in an environment where you're not starting from 16% yields on 10-year treasuries. You're starting from 4.5 to 5. And the Fed has a massive balance sheet and is not in control of its balance sheet. And the US government is deeply indebted at the end of the big debt cycle. So all of those things make me question whether or not this really is our Reagan moment, and whether Kevin Walsh can gracefully accomplish the things he says he wants to accomplish. I think that remains to be seen. So all of that, now we can start to look at emerging markets a little bit, and emerging markets in a world of financialization of everything, right, where they have less leverage, right? They're more subject because they're not really in control of the finances, and the things that they are in control of, namely their own population and their own commodities, assets, etc., right, are less valuable in an overly financialized world. So if we are really going back out of deglobalization, if we are deglobalizing, if we are definancializing, that should be good for emerging markets in the long run. Since they are more commodity-based economies, real things should be more valuable, but we'll see. Definancialization, deglobalization, those are painful processes for the people that are in power today, particularly. Whether they'll kind of allow that to deglobalize and definancialize gracefully, or whether there's going to be, pitchforks and and fires is, I think, remains to be seen. All right, so now let's, with that context, take a look at some cycles and our cycle analyzer and how to use it with regard to emerging markets. All right, so I'm starting over here in our watch list configuration, right? I went to analytics, watch list scores. I just added a new cluster called MSCI Emerging Markets. And I'm going to go over to my list here that I found at iShares.com and start to add a few symbols in here for, so like this was core MSCI, and I'm just, again, showing how to use our tools. IEMG is the ticker. I'm going to grab that data from Yahoo Finance, and we're going to put it in the MSCI Emerging Markets cluster. Okay, so now I see it down here in that cluster, and we'll add a few more here. Let's see, we're going to add, all right, emerging MSCI EMX China is EMXC. And MSCI South Korea is one that's got a fair amount of assets, and I'm just going by net assets. Looking at another list over here, that's EWI. India is INDA. And Brazil is EWZ. China. MCHI. And sure, Taiwan is EWT. Any other biggies in here? Latin America 40, Mexico. Why don't we do Mexico? That is EWW. Okay. All right, so that's enough to work with. So we've got a list here now in our MSCI emerging markets, and we can close this. And go to our list here. We could start with any one of them. Let me just go to watch list scores again. I think, yeah, here it is. Okay, so now we can see it showing up here in my MSCI emerging markets list. So these watch list scores are handy and a nice tool, a nice feature of our service. And we can work from this going forward. So I'm going to start with the core MSCI. I'm just clicking on it and opening that up. And I also just want to note that we can go over here and click on the little hamburger, open this list up here, and I can see all of the elements that I added to the watch list here now too. So that's another nice feature of how to work with these tools. All right, so I'm going to close that now, and I'm actually going to start from scratch here. Okay, this is daily data, by the way. And if we look at, so this is emerging markets, core emerging markets from MSCI. And right away, you can see we've got this longer cycle out here, 332. It's the #1 stable cycle at 87. That's a very high stability, pretty good on the spectrum, but I'd want more than 850 bars for a 330 period cycle. I want at least 3 iterations of that cycle. So let's add a couple hundred bars here, update our analysis, and we see this longer cycle still out here, getting a little more definition if we give it a little more data. And we can see, you know, some decent structure here in this cycle. You got a bottom, a bottom, a bottom, and extending past the top here. It's the #1 stable cycle with a stability of 89, and it's got a rank of 1 from the spectrum. So that is definitely a cycle I am interested in. We can add the RSI, and we can add the cycle swing momentum here. And we see that both of them are pointing to the downside right now, but we haven't quite gotten the sell signal from the cyclic RSI here. So to me, you know, for the broad emerging market complex, I think this is the broadest of the emerging market ETFs. And on the longer term, the cycles are signaling caution for emerging markets. I find that to be consistent with what I suspect Kevin Walsh is going to have to do. In spite of what he says he wants to do, it's going to have to make sure the system is maintained rather than really let the system adjust, but we'll see. Again, he's not even in office yet. The 320 is interesting. If we go look at the shorter term cycle here, the 78 looks pretty interesting. It's also topping, but you know, we got bottom, bottom, bottom. Clearly it's been in an uptrend, right? but you've got both the 78 and the 320 flashing warning signs for the broad emerging markets. All right, so I think we might just go out and look at some weekly data. Not sure how far back the data goes on IEMG. Looks like it only goes back 313 weeks, which is not going to be enough for us to really do some good analysis. 63 is on here, but 63 times 5 is roughly that 320-day cycle that we were already looking at. So nothing really new here from the weekly data. All right, let's go now back to our watch list here. And the next one we're going to look at is, I think it was, did we put EEM in here? No. So the next biggest one was EMXC, right, which is emerging markets ex China. So that's worth a look. Again, we need to add a little more data. I think we added 200 bars to get some more clarity on that longer term cycle out there. And not surprisingly, we see a similar pattern here to what we saw in when China is included. Okay, at 326, we have the cyclic RSI and the cycle swing momentum. And it's a very similar picture to what we saw in the broader core emerging markets ETF. So nothing really new here. And I think we can move on from there and start to drill down into some individual markets. So next was EWY, which is South Korea. We got 850 bars here, but we're going to have to add a little more. Got 324, 79, pretty much everything is red here. South Korea has been doing very well, kind of on a tear, right? Definitely always want to be careful in terms of stepping in front of a major trend like this. This is from where December of 25 all the way up to the present moment. So for the last month and a half. But, these longer term cycles, I think certainly would make me a hesitant buyer of South Korea right here. So everything's still kind of lining up between the emerging markets. They're all showing a very similar pattern, which in and of itself is interesting, right? Let's keep going. Let's have a look at India. Okay, India here. All right, India actually looks a little bit different. Doesn't really have much definition out here at the longer end in the 300. Let's say we've got about a 165 and a 224. So in this case, we actually don't need as much data. So let's tighten it up a bit. Maybe we go anchor on a more recent bottom here. Now we've got 725 bars. That's plenty for a cycle that's 161 periods. So it's a number 2 ranked cycle, and it's got a stability of 68. I like it. This 116 is also interesting. They both are pointing down at the moment, the 161 and the 116. It is interesting that the momentum's pointing up on India. And, India has not been doing as well as South Korea over the past few months. And momentum is starting to turn up, but we are do have cycle headwinds here. So I'd be more interested in India from this perspective than I would be in terms of what we looked at from the other cycles, the other markets. So India looks mildly interesting, but not a buyer here, but looking for, I'd be interested in keeping an eye on this one and seeing what happens as these cycles start to move a little further and see what happens with the momentum. All right, next is EWZ, which I believe is Brazil. Yep. So Brazil, kind of similar to India, got this 158 cycle here. Clearly, Brazil has been on a tear back from similar time as South Korea, moving up sharply, momentum well out above its band, and cyclic moments, CSI also green pointing down, but not below the 0 line. So not a buyer here, but keeping, again, keeping an eye on it. Looks to me broadly like what we're seeing in emerging markets is that kind of extended, had a good run already. We'll see what happens into March and April. And wouldn't be surprised to see some pausing, at least in these rallies, if not an actual correction. MCHI is China. Interesting, a lot of cycles in this spectrum. I mean, if we just look at this, right, a lot of cycles there. That's interesting. If we go back and look at India, just looking at the spectrum, there really weren't that many cycles. Clearer that one big cycle at the 159 is dominating the spectrum there. But if we look at China here, it's a different story. We got lots of cycles to choose from, which frankly makes things a little harder. But let's take a look. Let's do our cycles analysis. So probably the most striking cycle on here is the 111. It's got a stability of 63, which is very good, and a rank of 1, right? We don't need this much data to analyze that cycle, so we could actually shorten it up a little bit, maybe go back here, see if it's still holding up. So yeah, 123 there for that one. And I think, it's important to note that particularly the CRSI and the cycle swing momentum are both pointing down. Yeah, the cycle is pointing up a bit here when you shorten up the data like this, but these both give me caution. So let's take it back a little further. Right. Yeah. All right. So similar picture. Again, China. We see this 116. Maybe we could also add this 86, though the stability on it just isn't quite there. So momentum in both the CRSI and the cycle swing, momentum pointing down in the red, and in spite of the cycle being up again a bit. So caution there. EWT is Taiwan. So Taiwan's interesting. We do see a pretty clean cycle out here at 320, right? And we've got 850 bars, but let's go out a little further. Add a little more data. Now we've got 1,050 bars, and we see this 312 now, which is similar, to what we saw in the broader core MSCI emerging markets. But again, we're past the cycle top. momentum pointing down, and pretty much all the cycles in agreement there. So continue to support the idea of pause, if not correction. And lastly, EWW is Mexico. Mexico has been on a tear pretty much since Trump was elected. So that's interesting. From a cycle perspective, okay, pretty messy and undifferentiated in the longer end of the spectrum. So we can focus on the shorter end of the spectrum. We don't need as much data to focus on the shorter end of the spectrum. And this 83-day cycle really stands out. And very similar picture in that we've seen kind of a very strong run up and momentum slowing and reversing, and the cyclic swing momentum pointing down as well. All right, so let me move back here. And so my big picture, as I see it so far, is that Kevin Walsh wants to do things differently than Jerome Powell. I like what he wants to do. I don't think he can do it. I don't think he can do it and still help Trump get elected, reelected. Succeed in the midterms and have the next president be Republican. I think there's going to have to be some pain before things really reset. That's my belief. I hope I'm wrong. I would love to see Kevin Walsh succeed in getting the Fed out of the way of the private sector. Trump does want to deregulate, and he is deregulating. There's some hope in that. So we'll see. It is a time that we have to be vigilant. We have to be paying attention. We don't have crystal balls. We don't see what the Fed gets to see. And, I was watching Bloomberg the other day, and Bob Michel from JP Morgan was on talking about some upcoming, event that was happening. Maybe it was the Fed meeting, I think, right? And he said, "We see everything." And you know what? I believe him. They see everything and we don't. So that is my kind of concern. I'm not seeing any big red flags yet. The cycles on equities in the US are certainly cautious. And when we look at emerging markets and we think about the role that emerging markets have played in a world that is, globalized and financialized, right? That's what's been going on since the past 44 years, with rates coming down from 16% to 2% on the 10-year yields. Now they're up to 5%. Emerging markets have suffered from not being in control of the global financial system and having financial assets be more valuable than real assets. I do think that's shifting some now. So I think that's positive for emerging markets longer term, but I think that it's not going to be a straight line. And the cycles right now are suggesting that the rallies in emerging market equities have reached their cycle peaks, and cycle momentum is also indicating caution. So I would expect at least a pause, if not a correction. And and the cycles kind of support that thesis as well. All right, so Rowan, is that Indian chart in USD? Yes, I think all these MSCI funds are traded on US markets and are priced in USD. As you just covered Brazil, maybe look at some Argentina stock. Argentina ETF is not representative of the Argentina market. GGAL or TIO have a good history and are representative. I wouldn't mind looking at those Gilebrechts if if we can find tickers on them. I'm not sure. If they're on Yahoo Finance, we can do that. All right. Mexican President Sheinbaum elected at bottom price. Right. Good point, Sherman. And thanks for joining us. And yeah, so Mexico has been going straight up pretty much since December of 24 when Trump got elected and Sheinbaum got elected shortly after Trump, right? And, you know, I do think Mexico is a beneficiary of Trump's Don Roe doctrine, so to speak. And, you know, sometimes structure Trump's cycles. So it remains to be seen. You know, it's sort of like, are you buying gold at 5,000? I'm not. Are you buying silver when, you know, at 120, when all the cycles have said that that move is exhausted? I'm not, you know. So that's kind of how I see things. All right, so I will take a quick look if I can see. Maybe we'll pop over to Yahoo Finance. GGAL looks. I'm assuming this is the one you were talking about, Joe Brooks. So looks like we can do it. So if I look at this one, the spectrum here is not giving me a ton of confidence, but this 148 cycle here has pretty good stability. I might want to tighten up the data a little bit just to get a little more precision in that. I don't need to go out 6 or 7 cycles. 3 or 4 is enough. And it does tighten up a bit. So here we add cycle swing, cycle RSI and cycle swing momentum. Pretty darn similar picture of cycle topping with momentum, CRSI, and cycle swing momentum pointing down. You know, not as extended as Mexico, for sure. But all the emerging markets that we've looked at give me pause when I look at the cycle analysis and when I think about whether or not emerging markets day in the sun is really here or not. So over a longer time frame, I think emerging markets are going to benefit from a world where real assets, real things are more valued than the US dollar and other financialized things. I don't think that the over-financialized assets are going to continue to buy the real things that they've been able to buy, you know, over the past 20 years. All right, gang. I think that's a pretty good picture of where I think things stand at the moment and what's going on with the cycles in emerging markets. Remember, cycles are conditions, not necessarily triggers. They're part of an analysis of the big picture. And appreciate you tuning in. And if you haven't signed up yet for Cycles in the City, I hope you will. It's going to be an incredible event, and I hope to see you there. All right. Thanks for joining us this week, everybody. Careful out there, and I'll see you again next week. Bye-bye.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
The foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.